Have you ever wondered how the amount of money flowing through our economy is managed? Central banks significantly influence the money supply primarily through a powerful tool known as open market operations, or OMOs. By buying or selling government securities, they directly inject or withdraw funds from the banking system, which then ripples through the entire economy. The core mechanism behind OMOs is quite elegant. When a central bank wants to increase the money supply, it buys government securities from commercial banks. It pays for these securities by crediting the bank's reserve accounts held at the central bank. These increased reserves give banks more funds to lend out. Conversely, to decrease the money supply, the central bank sells government securities to commercial banks. Banks pay for these securities using their reserves, thereby reducing the amount of money they have available for lending. This action directly impacts the federal funds rate, which is the interest rate banks charge each other for overnight loans of these reserves. A lower federal funds rate encourages more lending, while a higher rate discourages it, influencing the broader interest rate environment. So, how does this affect you and the broader economy? When the central bank buys securities, increasing bank reserves, banks have more money to lend, leading to lower interest rates on loans for consumers and businesses. This encourages borrowing and spending, stimulating economic growth. On the flip side, when the central bank sells securities, decreasing bank reserves, banks have less money to lend. This tends to push interest rates higher, making borrowing more expensive, which can help cool down an overheating economy and curb inflation. These changes in reserves and interest rates have a multiplied effect throughout the economy, known as the money multiplier effect. This process is not just about direct reserve changes. It also signals the central bank's policy stance to financial markets. For instance, a persistent pattern of buying operations signals an accommodative monetary policy, implying future interest rates might stay lower. This forward guidance helps financial institutions and businesses make more informed decisions about investment and credit. The central bank uses two main types of OMOs: outright purchases or sales for permanent changes, and repurchase agreements or reverse repurchase agreements for temporary adjustments, offering precise control over liquidity. Ultimately, open market operations serve as the primary and most flexible tool for central banks to manage the nation's money supply. By subtly adjusting the availability of reserves in the banking system, they influence lending, interest rates, and overall economic activity, striving to maintain price stability and foster sustainable economic growth. It is a powerful lever for steering the economic ship.